Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. US seems to be in a unique situation. The underlying growth in the economy seems to be holding up, despite the pace at which rates have increased from near 0% in March 2022. On Friday, the personal consumption expenditure rose by only 3%, which was below an expected 3.11% rise. However, it seems the core figures have comfortably settled around 4%. Morning, JK. Can you please interpret the PCE figures for us, and what are your thoughts on the markets this week?
Yeah, good morning. Yeah. So inflation obviously has risen at its slowest pace in more than 2 years, with underlying price pressures have receded. And good thing is that it is the core number that has been coming down. So that should give a lot of comfort to Fed, who has already kept his options open as far as the future monetary policy is concerned. And this is also following the CPI data earlier in the month, which had actually shown a sharp decline. Now, the good thing about the US is that the growth has not really taken a hit despite a big interest rate rises, as you mentioned. Like last week, we had the GDP number that came at 2.4% versus 2% previous. And other indicators like housing, durable goods, and consumer confidence have all been strong. So currently, we are looking at a Goldilocks economy in the US, with the Fed probably likely to succeed in a soft landing. But if we compare it with other economies, they're really struggling, Europe and then China. And US is expected to run into a bigger challenges going ahead as well. And speaking of Europe, we had the inflation numbers in Germany and France, both coming lower than expected on Friday. And then the GDP number from Germany was also lower than expected, although it was not a negative number. But overall, if you look at the IMF forecast for Germany, for the year 2023, they expect Germany to be recording a minus 0.3% growth for the full year. So ECB is definitely in a very difficult situation, whether they want to focus on growth or on inflation. And one more number before they meet next, if it comes better, that would give boost to the euro doves, or rather the ECB doves, who will support a pause. And Lagarde, of course, lost no time on Sunday to retrace some of dovishness of Thursday, saying that a rate hike in September is still a possibility. And of course, it may be followed by a pause. So it's a lot of uncertainty as far as Europe is concerned, but definitely growth is taking a hit there. And we have the Eurozone CPI number, flash CPI number, which will be announced today. The expectations are for a small rise. So that keeps the policymakers, further in a difficult situation now as far as the future number is concerned. And at the same time, if you look at Chinese number, the non-manufacturing PMI today fell to 51.5 from 53.2. Once again, confirming that China is yet to recover. But the policymakers' moves are being now slightly recognized by the markets, and Chinese markets have been the best performing last week, recording a more than 3.5% rise in the equities, and also the Chinese one, which has come to better levels now at 7.14. And now all this is like, what this means for the currencies is that USD is to remain stable to slightly strong against the major currencies, while the growth picture, US and no higher inflation, means that it's good for EMs who are particularly dependent on exports to the US, who are export dependent rather. And that would be seeing the dollar weaken more against the EM currencies which are having higher yield. We have already seen Mexican peso outperforming most currencies, by recording a 7.5-year high, and way higher than what it was even on the COVID time. And the Brazilian real is soon to follow, and of course the South African rand and Korean won on the Asian side are also on the strengthening side. They are all getting boost from not only the US growth picture, but also the fact that major economies or major central banks may be closer to a peak in their rates as inflation drops. On the yields, of course, yield has taking its cues not only from inflation but also from the supply side of paper in the US. That is why we did not see a overall net drop in the yield as far as US 2-year and 10-year is concerned. In fact, 10-year rose more by about 6 basis points during last week. German yields, of course, were not rising as much. Therefore, the yield differential with the US has widened, and that has put some pressure on the euro as well. Now, the biggest, the event obviously was on the Japanese side, who modified their yield curve control stance by making it 0.5% cap a reference point, and will conduct fixed rate purchases at 1%. So they have adopted a more flexible approach to the yield curve control policy. In fact, Governor Ueda played down the effort, noting that it does not expect the 10-year yield to in fact cross 1%, and that the move was not a step toward normalization. So the inflation forecast for the fiscal year has also been raised to 2.5%, which is not so much of a rise, or rather so much of a big number that can help them keep the policy still on the easier side. So the initial reaction of strengthening yen, obviously the market recalling the big move that was seen last time they changed the yield curve cap, but they were disappointed as 138 did not break convincingly, and then we are back above the level seen before this news at 141.50 plus now. So the liquidity is still abundant as far as Japan is concerned, and that will keep the Japanese yen on the slightly on the defensive side. But yes, I think if it starts to weaken towards 144 or 145, the Japanese yen or rather Japanese authorities might directly intervene. So all action in Asian time, both on Friday and today in Japanese yen, led by Japanese policy makers. Now, as far as India is concerned, we did have a gap up opening on Friday, just slightly surprising because the moves apart from Japanese yen was not very big, and more surprising was the fact that the higher level above 82.20 actually sustained, and even as we speak, it is still trading above 82.20 levels, and this might have something to do with the fact that 82 has held on a monthly closing basis, and also we have the oil price, which is now pushed quite a bit, about 18% from the lows, which is not good news for our trade deficit, which has already been rising in the last 2 months, and exports not rising but imports rising, and so we should expect the rupee to slightly settle itself on a slightly higher range, maybe 82, 82.40, 82.50 levels. Of course, if we do see a large capital flows, and then we really look forward to the central bank to observe the flows. Otherwise, we might again go back to the lower levels. But right now, those possibilities look less, because we are already seeing some slowdown in the FI flows, and we are also looking technically at a correction in the in the Indian stock index as well. So look forward to more data this week, starting with Eurozone inflation, and then we will have the PMI number as well as the US job numbers on Friday, which will give more clues on the economy. Thank you.
Thank you, JK. And just to quickly summarize, inflation in the US has been rising at the slowest pace in the last 2 years. Core number is coming down, which is good, which is something Fed has been aiming for all this while it seems the overall economic situation seems like it's in a Goldilocks with the possibility of soft landing. This is from a US perspective. German and French inflation were lower than expected, along with lower than expected GDP growth for Germany. So it's something concerning for the ECB, which is trying to balance growth and inflation. Chinese non-manufacturing PMI fell. However, it seems their policies are being perceived as something that's working for the country as of now. And the big news was from Japan, which opted for a flexible yield curve control, and the 0.5% yield cap not not being set in stone, but rather they are allowing some sort of movement above 0.5%. That's it from us today. Thanks for listening. Tune in tomorrow to not miss the latest updates in the financial markets. Thank you.